We had a simple model where we plugged in some parameters for growth and we defined how things would work for GEM. Let's take a step back, zoom, okay, there we go. Just going to format it so that we know where it is. So that's one. Then we also define the product mix for GEMs across the years, and this is something that we want to play with a bit more today once we have the model finished. Then we projected revenues based on this product mix for students, and we also projected expense. So we've got the baseline numbers here. And then from here onwards, what we've done is we've gone and plugged the numbers in the income statement. But we have a couple of other components in the income statement. And we need, in some instances, we need data. In some instances, we've got historical record. So the bulk of the stuff, the big item from an expense point of view for GEMs is the staff expense. There are a couple of other elements that we'll take a look at it quickly. But from our perspective, from our expectations point of view, that's the biggest item for GEMs, right? So what we want to do is we want to plug in the rest of the items. So after staff cost, you've got employee benefits. And for the time being, what we'll do is we'll use in some instances, because we want to keep the model simple and to the point, in some instances, we want to just use historical values. We'll update those historical values, build submodels for them later on. So for instance, employee benefits running at about 10.5 in 2018, and we have it at 13.3 in the 3 projections. So I'm just going to use the 13.3 figure here, and I'm going to use it as is. So that's where the number, it's a hard-coded figure. Management expense about 5.1, I'm going to keep it at 5.5. Rental and operational lease, now this is a big item. How and where does this come from? So if you go back to your model, this is a function of rental and operational lease per school, and then it's multiplied by the number of schools. So we'll use the same model. We'll actually go out and plug this figure in, and we'll say the rental operational lease per school per year. This figure here, right? So we'll just take the 1.7 figure from here now, and then we'll say leases are going to stay stable for the time being, but they're likely to start rising as we move forward. So we'll get to 1.8, 1.9, and 2.0 by the time we get to 2024. So now once I have this populated, all I need to do is take the figure above, which is the rental and operational lease per school, and multiply this by the number of schools in my system, which is 48 here. There you go. So that comes down to 80.9, and format it, and then scroll it and extend it. So that's maintenance and service. I'm guessing this is a function of schools. So this is 15.7, and from our calculation point of view, it's going to be 15. Let's call it 16. So let's call it 16 divided by the number of schools, which is, let's say, 50. So it is 16 divided by 50 is about 320,000, right? So I'm going to use this value, maintenance cost per school. Where to add it? Let's just add it here. Maintenance per school. I'm going to plug this in as 0.32, 0.33, 0.34, 0.35, 0.36, and then stabilize it at 0.36 per school. So this is again something which is linked to the number of schools in the system. So 0.32 into the number of schools is here, 15.36. All right, so that's 2. Then bank charges, I think, will remain static at where they are. It's about 4 million. And then depreciation. Depreciation is, the concept that we explained earlier. It's stable at 68, 68, 68, 68. So I'm going to use 68 for now, and then figure out if we need to update this later. So I put in a hard-coded value here for now, but the value is going to change a little later, right? And this gives me my total teaching expenses. So if I sum all of this up, this gives me a head of what my overall expenditure is like. And it's 545. So it's 545 million. So at first look, GEMS, looks interesting, at least based on Outlook. How does this compare to what they've done earlier? So here, you see this. You can see this is about 708, 684, 700. So something's off. Something that we've done in our calculation is not tying in the way it's supposed to be. So one piece is this. We have to add this piece. Let's add this. So if I add this, this is fine. So you can't have a sudden dramatic drop of almost about $250 million over a year when nothing really drastic has happened. So this is a first cross check, right? What have we done? We have this figure, this series that says 545 to 520. We're just doing a quick cross check with what does our historical experience indicate. And our historical experience indicates that no, Jawad, you're like completely off base. It's about 700 million. It was 700 million in 18, it was 640 in 17, it was 540 in 16. So about 700 million. It's projected to be about 680 million in 680 to 700 million in 19, and we are looking at 545. And the biggest difference is here, which is the staff cost, which is 358 and 517 and 5. So there's almost a difference of about 150 million here, which we need to figure out why is that difference there. And I think one reason for that difference is if you think in terms of your expenses, your expense mix, this mix is off. Even though from your perspective and your point of view, this 568 that we picked up, this we picked up from teaching expense per student. 558 was, it's 5.83. We picked the wrong value. Rather than picking a 5.83, we picked the wrong value. Do you see this? Teaching expense per student. So the value we picked yesterday was 5.58, but the actual value at 18 was 5.83. And our guess is that it should be a little higher. It should actually be closer to 6. So let's update this. So rather than using 5.68, we use 6. Put in 6, 6, and 6. And then let's take a look at what the numbers look like. No, it's still not. Expense is still lower. Not that high. Okay, then what else can we do? So then let's raise this to 125, 120, and that gets us to 300 million. It's gotten a little better. It's gotten to 488, but still short by about 200 million. Sorry, 200 million. From 250, it's down to about 200. 300, it's down to about 200 million. So what else do you think we need to change? Maybe we need to check the formula and see whether our calculation for expenses is correct. So let's just do a quick double check. Number of students, these many number of students, times the expense. So if we trace the formula like so Fn F2, if we trace the formula, this is what the formula tells us. R8 is number of students. R11 is the proportion that falls in Premium Plus. J11 is the benchmark expense for that category, and G11 is the offset for that, right? So this makes sense. So this is fine. And then the next one, which is 147, if I trace this, this is also fine. So it's picking up the right values from the right place. And 739. And then this one. Yeah, this is also fine. Oh, we're looking at the wrong value. Again. Did you see what just happened? Staff cost, this number here, 301. We've picked the wrong cell. Rather than picking 739, which is your actual total student expense, we picked your margin per student. So this is a common mistake, right? This happens, and this is, which is all the more reason for you to cross-check and calibrate your number every time you hit a major milestone. Every time you do a major calculation, it's important that you go out and double check the number you're looking at. We did a calculation, this calculation here, and the number that we looked at, 488 million for total teaching expense was a lot lower. It was almost lower, about 200 million as far as our math was concerned. So then we said, okay, what's wrong? So we scrolled all the way down here and we said, okay, what numbers are we looking at? And then when we checked, we found that we had a value for teaching expense per student that we already calculated, and that teaching expense per student, this value, this row, we picked the wrong value, not picked the right value, right? So we went back and updated the right value, but that didn't solve a problem. Then we looked at the calculations for the formula, so we checked everything, the formulas were all right. And then we realized that rather than using this number, we had used this number. So all we need to do to fix it, update this, is to replace it by this cell reference, R27, replace R27 by R25. So if I scroll down, all the way down here, this becomes R25. And that solves my problem. Okay? So this is done, this is better, this is much better. Scroll back up again and reduce. So we changed a few things. So we brought this up. So let's just bring 120, 115 and 110. All right, so far so good. So what's our margin? So our gross margin at this point in time is going to be 1040, which is the gross revenue figure, minus 9.14, this value here. Cut and paste and scroll it all across. If you think in terms of the assumptions we've used, right, what's our outlook? Our outlook is essentially zero growth for the next negative growth for the next 3 years, and then minimal growth for years after. Significant negative growth, so minus 3% in growth in schools and minus 5% per year in reduction in number of students. And there are mixes also changing. It's it's sort of leaning towards more low-end customers and low-end students, in low-end schools compared to our premium and premium plus schools. Right, so now the next step is, so now this is where things get a little interesting. You have a couple of choices, right? For now, what I'm going to do is I'm going to just go through the first pass of the model, but there are a couple of shortcuts that I'm taking, which I'll have to sort of come back and fix a little later. But for the time being, we'll just go out and do that. So other expenses is 123 million in other expenses. We don't have the breakdown here in this sheet, but if you look through the financial statements, you'll find that there is a list of stuff in there. So I'm just going to take 123 million, which was the last year. If you take 123 million in other expenses, that's going to eat into margins even more. So operating income is now even lower, just like bare bones. They're just hanging in there by a thread. So 19 is going to be a really tough and difficult year for them, at least based on the math that we're doing right now. There's hardly any space for anything based on these projections. And then your financial income is about 2 million, which is basically, money they have on deposit, interest that they're earning on advances and fees that have been received on behalf of parents. And their financial expense here is about 93 million. So I'll just put that in, 93 million. And this 93 million all the way from here to here. So your net finance expense is going to be this minus this. It's about 91 million. All right, okay. So income before taxes, there are no taxes in the way, but just in case, income before taxes is going to be a big loss. So GEMS are not in a good place and a good position. Now we know how to fix this, right? We know how to fix this because this figure, this 727, is a little higher. And there is some margin in there for GEMS to update, right? So if I go back to my 727 calculation, where does this come from? This comes from our engine on top. And where does this come from? This comes from these figures. And we updated this to 6 from 5.83. Let's see if we can bring this down to 5.8 again. 5.8 again for all of them. And then see where that takes us. So 727 will become about 702. So that'll save some amount. And so there is some improvement in margin, but there is still a hole. It's not looking pretty for GEMS. Your margin on premium school is 0. That's, oh, is that right? No, it's expense offsets about 120% of this, and this is about 130%. So what you're basically saying, for each of these schools, this is going to be about into this much. That's your revenue base for these schools, and your expense base is going to be this into this much, 6.96. So if you think in terms of actual margin is going to be about this minus this. So you make about $4,000 per student in the premium plus school per year. You make about $3,000 per student in the premium category, and you make about $2.6 thousand per student per year at the entry level. All right, so I think now the big question is, so this is the same challenge we faced with Maya. If you remember, when we did the first pass on Maya, the numbers didn't make sense, right? So we said, what can we do? So we added customer retention, we tweaked the pricing model, we played with a couple of other parameters. Here, what do you think is driving this? We know for a fact that they have an operating cash flow of 200 million. But in our model right now, that operating cash flow is not showing up. So if you look at the financials that were shared from GEMS, in that list, you actually have a breakdown between what is the actual mix of schools between what we call the premium and the premium plus category. Take a look at it now. So now if you look at this, you can see that if they've got, let's say, in 2018, they had 118,000 students, and of those 118,000 students, in terms of a mix, about 68,000. So that's this number. This is a good figure for us to look at. Let's just see if we can use this. Let's see if we can use this as a basis for our calculation. So 27, 22, and 68 out of 118. These are the three numbers: 27, 22, and 68, right? Let's go back to our Excel sheet again. And check the math again. So we've used this math. So it was 27, 22, and 68. This is the actual breakdown, right? It was 118,000. So I'm assuming this was maybe a 3, this was maybe a 2, this was maybe a 5. So that's the actual breakdown, which then gives us okay. So we're a little off, and we can tweak that f function f4. So that's 23%. All right. So let's use this, right? This is the actual percentage. So let's see if we can use this for our engine and see if that improves things. So this is going to be 23%, 19%, and 58%. So this is one thing which is wrong in the mix. So we fix this. 23, 19, and 58. This would be maybe 22, 18, and 60. And I'm going to use this for the next 2 years, which is 22, and then this will start to go up again. 23, 20, that's 57. So what did we just do now? We plugged in certain assumptions with respect to product mix. We went to the source. The source is the financial statements that GEMS provided, the half year 2018 financial statements that are there in your folder. So we use that. That was 2. And then we plug that back into the model. And does that solve the problem for us? So the revenues look a little better. Yeah, margins improved, looks different. And then, I know, still off. There's still a significant difference in expenses. What do you say, guys? What do we do now? So let's see. The total expense is about 684 million here. So depreciation is fine. This one's fine. 15.7. This is fine. Maintenance service, operational leases are also fine. Management is fine. Employee benefits fine. Staff cost is about 500 million. And staff cost is off. Staff cost is off the charts. Staff cost is off by 200 billion. You can't build models in isolation. You have to calibrate models with the reality on the ground. No, but we have to calibrate it, right? We can't move forward till we fix this. So if I now look at it, it's about 608. 608 is still off by about 100 million. Staff cost is about 517 and I am at 608. So I need to shave about close to $90 million off staff cost. All right, so maybe this assumption was faulty on our part. Maybe this is 95 and this is about 85%. Still out. It's about 80%. 560. 100. This is about 90%. 552. 75. Okay, 522. This is 533. This makes sense. So if I now bring it down, go back to this number. 1056, 534. That's better. 721. That is better. And 212, 93, 121. That's better, right? So now this is more in alignment. 121 in 2019. This figure, these values are more in alignment with the values we'd experienced in 2018.